If you have no money, you fail and you cannot keep doing anything. You can pull up a Uniswap, you can pull up Aave, you can pull up Compound, and you'll find one key thing: you're making money. Condoning speculation for tokens and all that, but I'm just stating the facts, and no one has been able to prove me wrong and show me one token that has more utility than speculative volume. So if the value of the token, which is determined by the investment into it, was actually true, then why did it crash so much after the launch? In fact, we found in almost every case it was overpriced. Why? So people could dump and they can take money from it. Do we have enough liquidity in the pool? I'll give you an example. There was one project, not going to mention names. They had a $25 million market cap. There's only $25,000 in the liquidity pool, and they're marketing like crazy. And I showed them, I said, you know what? If I go to your DEX right now, I can't even buy $5 grand of your token without a warning on Uniswap. And you guys are marketing all the time. Like, what are you guys doing?
Hi everyone. Before we get started, if you enjoy watching or listening to this podcast, please hit the subscribe button. It's free to do so, and it helps NFK Podcast to bring more exclusive insights and interesting guests in the future. And if you find this episode useful, feel free to give it a like or leave a comment with your favorite moment. Now, let's begin. Enjoy. Today we're looking at the discipline that sits at the intersection of protocol design, capital markets, and on-chain governance. Tokenomics functions as the operating system for decentralized networks through its influence on supply issuance, liquidity formation, treasury strategy, governance power, and incentive design, and more. Our guest today is Tony Drummond, founder of Tokenomics.net, where he advises protocols on token architecture, treasury management, governance systems, and incentive design under real market and institutional constraints. Tony, thank you very much for joining me today.
Thanks for having me, Nasib. Look forward to being here.
Let's begin with your background. How did you first come to work on tokenomics as a discipline, and what motivated you to found Tokenomics.net?
Yeah, so my background is unique. I've actually am a founder in this space. In 2021, I launched my own project. We grew it to over $200 million. We had a community of 75,000 people. And then what got me into tokenomics is actually encountering my own challenges, thinking you knew what you knew as a founder, thinking it was right, moving forward, finding problems, understanding that it was not set up correctly, seeing the problems and having to fix all those. That's actually what I had to do within my own project. Seeing the actual, communicating to the community, we had to make these changes. So I've actually been through all the trials and errors of actually doing it right, doing it wrong, and having to make all these changes. And so kind of coming out of that experience, I thought about how I can help other founders in their journey. Tokenomics was a big challenge for me, and I got very interested in it, and I love liquidity and all the different aspects of it. And so I decided to focus there about 4 years ago. I've been doing that ever since.
Many teams still treat tokenomics as something to finalize before launch, right? That's an interesting phenomenon. So, do you define tokenomics as a living system rather than a static model?
Yeah, how I look at it is like what you want to do is you want to have a real business model. That's the first step, right? So if you are just only thinking token, like a lot of people are, you're not thinking correctly, right? Because the token can fail. And if it fails, that means you have nothing, right? So what are you building that has a moat that can drive value for customers that you can attach a token to? That's the question I have. If you can't answer that, then you have a problem, right? And so that's ultimately the biggest thing is how do you get it attached to something that has value, right? So because if you don't, then no matter what, you're probably going to be more speculative and have a lot more failures, right? And that's the whole point is how you look at what a token is attached to is ultimately deriving its value, right? A token as a product itself, those are called memes. Those are the only instances where I found it to work aside from maybe like a Cardano. You have to build and you have to deliver alongside real user base. And that's what I'm excited about is helping companies do that.
Across the projects you've seen survive multiple cycles, right? So, what do they share economically that failed projects often misunderstand at the outset?
Yeah, it all goes back to business model, right? Because if you have no money, you fail and you cannot keep doing anything, right? And so when you look at your business model and you look at the ones that have survived, you can pull up a Uniswap, you can pull up Aave, you can pull up Compound, you could pull up a lot of these protocols that have survived, and you'll find one key thing: you're making money, right? Because if you are not making money, you don't have any money to survive, and this space is extremely expensive. So you will quickly find yourself at a loss. A good example of that is look at all the NFT projects. Even an NFT project that has a membership pass as the NFT, you make money once, then you hope to make money off of royalties. Well, do you really want members to turn that much? Probably not. So now guess what? You make nothing. You make it up front, then you make $0 for that on. And I've seen communities actually shut down because they run out of money. Why? Bad business model, right? So the whole point again is a business model. And that's what we do a lot of is we really at tokenomics.net, I build in a business model into your data room that doesn't just have your tokens. It has everything there, even the Monte Carlo simulations, how it might perform in the wild through data back research. All of that is there. Then we give all that over to development, marketing, right? Legal, finance, all these stakeholders can use the materials. That's how I really believe you should do it. Instead of, oh, we're close to launch, now we should work on our spreadsheet. It's not a spreadsheet. It's actually your whole business and it's attached to it. So if you're there, you're way too late.
I agree. When you evaluate the token economy before launch, right, tokenomics, what variables matter before narrative, valuation, or market positioning enter before those enter the discussion?
Yeah. The biggest one is actually you can tell a lot just by seeing what a team publicly makes available, right? So what I always think is you want to judge people by their actions and what they do versus what they say. So if they say, "Hey, we're a very sustainable project and everything's about the community," as an example, then you look at their tokenomics and you find 20% to the team, 20% to investors. Are you really? Probably not, because your tokenomics show me clearly you are not, and it's just lip service then. It's bullshit. Right. So as I look at it, the allocation chart is really the biggest one. You can tell right there who wants the money. It's all right there. So if I see 25% to investors, you can never tell me that you're community focused. If I see the community sliver has 2%, it's 12 times more. So you can never tell me you're community focused. Doesn't work. Right. So the biggest thing I would say you look at is the distribution, where those tokens go. As an example, just yesterday, Hyperliquid announced that now they're cutting back team token allocation in emissions. Why are they doing that? Because it was probably costing too much selling pressure. There were issues. What happened to price? Shot up instantly, right? So when you look at perception and what's actually happening, it's the distribution. That's a big piece of this. And many teams are greedy. Many people don't think that in advance, or they give tokens to people who will just dump and sell on them later. And then they might even have the misconception that, oh, that's my friend. They'll never sell on me. They will. Guess what? They will. Everyone will sell. So this is kind of the misconception is the distribution is the most important thing to get right and who tokens are going to, because that's going to determine whether it works or not, right? If I only give tokens to people who never sell, I should expect no selling pressure. If I give tokens as a free airdrop to everyone who wants to sell, had a guy yesterday, Tony, I don't have a whole lot of money now. I'm waiting for my airdrop to come through so I can sell, and now I'll finally have some cash. That person's adding zero value to that ecosystem. They're a pure extractor. So why are we giving them tokens, right? Stupid. Right. So when you start breaking it down into intellect and stupidity, you find a lot of the spaces working on a frame of stupidity, doing what we've always been doing, such as the airdrop allocation, which is ultimately not very smart because every project who's done that largely has failed. The volume all dries up immediately afterwards. Then all people just dump and take all the money from people who might have been buying the actual project. Now we say we have to do that for marketing, but we don't, because we were marketing projects through founder-led marketing, plenty, very good a few years ago. We started doing this crap because it was an easy way to market through Cato and all these things that spun up, but it actually is destructive. It actually doesn't take much skill, to do a copy-paste strategy. So that's why they say, if we don't do this, it won't work, because you have no idea of how to actually build a strategy. And that to me is ultimately the whole point. If the only way you can grow is giving out tokens for free to airdrop farmers because you're a DeFi protocol, you're destined to fail.
You mentioned founder-led marketing. Do you think that's the right way to go to move forward instead?
Well, I think so. Yeah, because right now, I don't know if anybody looks at my company page. Everyone knows who I am, right? And talks to me. It sees me on there online or whatever, might know me as a tokenomics person or whatever, right? So why would you, as a founder, knowing that when you're interviewing with investors, they're going to look at you, a vendor is going to look at you, a community is going to look at you, anyone that has any skin in the game with the brain in their head will check you out as a founder before they decide to get in bed with you and do business. So if they look at your profile and it's not there, it's incomplete, you don't look like a thought leader, why would I expect you, for example, if you're in solar energy and you've never worked in solar your entire life and you were at the McDonald's fry line, why should I believe you're a solar person? It's bullshit, right? It's not going to work. So when I look at how you
I like the analogy,
right? This is it, right? That's the brand. It's the people that build the company, not the company brand that builds the company. It's the people. If there aren't good people, it's not going to work.
I fully agree with that. Yeah. And should founders think about circulating supply not as a percentage, right, but as a risk exposure for the market absorbing future unlocks?
Yeah, if you look at your circulating supply, And here's the thing, that's called inflation. So if you look at what we have now and you look at what we'll have 3 years from now, and we say, you know what, over 3 years, we will have 20 times more tokens coming out of the market, that's going to be tough. And you know what? If those tokens, when they come out, they go and the price pumps, they're going to be worth even more money now, aren't they? And you know what? If they go to people who are going to sell, they're going to be selling even more on this, aren't they? Right. So, for example, Chain's a great example right now. You can look at a massive inflationary spike that's going to happen either today or tomorrow. They're going to increase the supply dramatically. They're going to release tons of tokens. Now, because the prices dumped down so much, it's not as much selling pressure as it was. A year ago, when I did the original video and they weren't down 95%, it was a lot of money. Now it's nowhere near as much selling pressure, right? So my whole point is those unlocks, the selling pressure, that distribution, that's one example of what's literally about to hit a project, right? And that right there will cause a lot of problems, especially if the price is pumped up. So when I think about circulating supply, that's a big piece of what I look at is the inflation. Who's going to get tokens and what might they do with them? That's going to tell me the future narrative of what might happen with price, right? Because if in the future, everyone who gets tokens will dump on me, then I should expect selling pressure. Like, for example, if all the tokens are going to investors in the future, no offense, VC investors, I should expect selling pressure until it stops. Arbitrum is a great example of that. The investors have been selling for over a year now, suppressing the price, through all the unlocks. So this is a great example again.
And all right, so token dilution is often criticized, right? And it's being criticized in isolation. Under what specific conditions does dilution actually prove network resilience rather than erode value?
Yeah, I would say when you look at real-world assets, real-world assets are a great example, right? So if I have silver and I have a market cap of all my silver tokens of $1 million, and I have an infrastructure fee that I make money off of that the silver tokens are used in, I can't make any more money than I can monetize $1 million of silver, can I? Right? So if I were to think about this, I want to get that $1 million to $100 million of silver. And if that protocol is making whatever, 5% a year or whatever it is, it'll make more money then as I have more silver, right? So when I look at an increase in value, increase in supply dilution, I think that's not an example of pure dilution because you want more assets on chain, but that's an example where I want to see a higher quantity of tokens and a higher growing market cap both at the same time. What I don't want to see is the opposite of that, where I see a higher growing market cap, the token prices going with this, and that's actually to like a utility token with a set supply. That's dilution, right? An example I'll give that of a good one now could be you have MetaDAO, and you have some other platforms similar that are going this ownership coin angle. Now, in the beginning, you start off with only the tokens you sell. Okay, so let's say you raise $3 million and you sell 100 million tokens, whatever. So you're raising $3 million and all tokens are worth $3 million, right? Because you sold them all. Now, if in the future you need more money, you can have a vote that the community can vote on. So the token holders might vote, yes, we need to raise money for venture capital. Let's mint some more tokens so we can sell them. And that's an example of dilution, just like it exists in the business world in equity. But it's an example of why does it exist, the scale, right? Not just to, as I mentioned, give out more rewards. You know what I mean? It exists for a positive business purpose.
No. And emission schedules fail frequently, right? I think it's also correlates with what we have mentioned. What failure mode do teams underestimate most? So emission velocity, recipient behavior, downstream liquidity constraints, so on and so forth.
Yeah. How much they're giving to whom? That's what you have to think about, right? So if you're giving a lot to people who will sell, then that's going to be, whenever they get tokens, expect it to be sold. Right? If you give tokens out for rewards, expect them to be sold for rewards, right? About 50% of them probably will, if not more. If you got staking emissions, you can go right now and you can do all the data analytics on what percent will sell their staking emissions. It's a lot. You can do that right now and understand your selling pressure, right? A lot of the stuff we want to know is out here. But most people are saying, well, that's not me. It can't happen to me. Right? So I'm really trying to think about distributions and who's getting what. That's ultimately the most important thing is who's getting what tokens and when. That will decide a lot of the fate and kind of selling pressure. I'll give you a great example of this. Now, you've probably seen projects that have problems. And what do they have to do? They have to do a community announcement. They do an AMA. Everyone there, hey, we have a problem. Here's the situation. Here's what we're going to do about it, whatever. Now, you might also notice at that same time, the whole chart is getting absolutely obliterated as they announce the problem on the AMA. You've probably seen that before. Like, holy shit, we got rugged in the chat. Like all of it.
Yeah.
Well, what's happening? What's actually happening? It's not a lot of people selling. It's only the people listening to the AMA that are selling. Think about it. It's creating such a huge dip in the chart. It's crushing everything. So it doesn't take much to kill it. And this is what I'm trying to emphasize, right? Is so
Yeah, yeah, yeah.
if you don't, right? So the whole point again is in that example, that was just an AMA that we've all experienced. Probably we're in a smaller project where there was a problem, and then notice only a small people started to sell, and it killed the whole price. I'll give you another example. There's one client I had where we looked at their staking emissions, and their market cap was right around $60 million. I looked at it 3 weeks later. The market cap had declined by $5 million. The liquidity pool had only lost $20,000. So what does that mean? There's a staking system that's emitting rewards, and all it took across 3 weeks was $20,000 of negative selling pressure to remove $5 billion in market cap valuation. So think about this. So it doesn't take much to kill the price. This is what I keep noting, especially if you have thin liquidity. If you have a thin liquidity on the DEX, and let's say you have only 100 grand there, and you have a $10 million market cap, it will not take much money to kill the whole price, right? So when I really think about this, it's like, what are you using the support price? Is that a function of centralized exchanges and speculative liquidity and market making? And then the liquidity pool in the DEX, is that what you're doing? Or are you only DEX? Because if you're only DEX, now that's another problem. You got all that pressure going to one pool if it does sell, right? So there's a lot that you have to consider and break out. And that's why it's not really a science of adjusting numbers on a spreadsheet like a lot of people like to think about. There's a lot of factors that go into it, right? And it's not
And a
just
lot of
percentage.
social factors as well. Yeah, yeah.
Yeah, everything, even the personas, the psychology, who might sell, the data. For example, you might come up with the utility, and this is something recently that we did. We had an idea for a lockup mechanic that was 3, 6, and 12 months. That was the lockup. We did some research. We found that nobody wanted to lock up a year. In fact, they wanted to lock up none, or 3 months, or 6 months. That was the maximum we were finding across a lot of different projects. So now we can do one of two things. We can move forward with the original idea, knowing that nobody will want to use that lockup, or we can change and we can adjust to what users are using now. And now we've aligned our system to something we've done research against, right? So we know they're more likely to use it that way, and now that's more data, right? If I would go on the 12-month lockup route, I don't have a whole lot of data on that gives me a lot of confidence. Now I'm building with that, right? So the whole point of when I look at all this stuff, it's an interconnected kind of web of all these different pieces you have to put together. And you have to look at all of it as one system. I think a lot of people just look at the spreadsheet and think that's tokenomics. It's not. That's only the supply side. That's distribution. You have all the other mechanics that go on inside of an economy that are the considerations that need the design, right? And that's where things can fail, all right?
How do you evaluate whether token utility generally constrains supply versus simply delaying sell pressure?
Yeah, I mean, I think that's a tough one, right? Because most of the supply and utility that we call it, here's the thing. Look at any project out there and find me one that has more utility volume than speculative volume. You will not find it. So what you will find is, in fact, you'll find a very small amount of token as utility and about 99% of it's speculation. That's what you'll find, right? So if you start to design everything thinking about speculation, thinking about utility will be everything, that will be a problem, especially in the very beginning, right? So let's forget that utility is something that we can measure and actually makes much more difference than we think, right? Because most of the market, as I just said, is going to be speculative. That's what's going to drive volume, right? So when we look at our overall volume and what could absorb selling pressure, it's not utility. Because if it was, then most volume would be from utility, wouldn't it? It's not. It's from speculation. So if we think about what's actually happening, what we have to do then is, if we have a real business and we have a real token with value on it, and we're building and we're scaling, that should create a perception of those more speculative type people to help reduce the selling pressure because they have confidence in what we're doing. Like if you look at Hyperliquid yesterday, the reason why the price went up is because I just said they cut back the emissions, the price went up because people expected less selling pressure, right? So a lot of what you're doing here is the psychological, right? I would love to say, and a lot of people have done this, where they run the mathematics and the token, the velocity, they got all these great formulas. It's all bullshit. None of it does anything because almost all of your volume is going to be through speculation, right? So you still have to look at it. In many respects, we build all the utility, I build all the revenue models, I do all that, but your question specifically as it relates to price action, it's still all speculation today, right? But if you don't have a real token with real value, haven't done the economics on that, then people can poke holes in that thing and they're not going to believe it, then that will fail, right? So the whole point is you have to get both pieces right. You got to get the utility right. So in our example, I build out a whole data room with literally a Monte Carlo simulation there with the utility, with the research, right? So we're going to show you across a simulation of 10,000 runs how this might perform with all the variation baked into it, all the stochastic variation baked in. We will run simulations on that alongside your business model what you believed was feasible from an assumption standpoint alongside what data we're able to find online. We will run all that out. That's an important piece to confirm that the model might potentially even work or where it might fail. That's what we do. Now, to say where it might go, nobody can predict the price, right? All that is fake, right? Because I could even list at a really high valuation, that would all dump down right afterwards. A lot of projects do that, right? So to use it, the thing I'm trying to get at is don't use it in the frame of trying to calculate a price, because that's all speculation. Use it in the frame of figuring out your fundamentals and make sure all that's there. And then know that if you have that there, now you have something to market to somebody who might be interested from a speculation standpoint. Again, not condoning speculation for tokens and all that, but I'm just stating the facts, and no one has been able to prove me wrong and show me one token that has more utility than speculative volume. Not one have I ever seen.
Yeah. I read your posts frequently, so I remember
Yeah,
you
yeah,
elaborating on that. Yeah. And okay, so at what point does staking stop being a security mechanism and start functioning as disguised inflation?
Yeah, I think, well, it's disguised inflation whenever we're using staking because we don't have a viable reason to have users locking, right? Let me give you an example. So I have one project where we have the utility token and we allow you to stake it. Now, if you want to stake the token, you have to become a liquidity provider and provide a certain amount of liquidity. So what we've done is if you want to use the token and stake it to earn yield, you have to actually create value for the system and provide liquidity. So you actually connect it directly to what you want, right? So as Charlie Munger said, show me the incentives and I'll show you the outcome. If the incentive is lock your tokens and dump them, in the example I gave, that's what will happen. So in the example project that I gave that lost the 5 million after 20 grand was removed, they were live for 4 years and they still had the same problem. They were advertising a 30% annual yield. And I showed them, I said, lock up your tokens for 30% that you think you're getting for a year. Let's see if you're going to get 30%. You won't. In fact, because of the selling pressure, you're down 70% by locking your tokens. Would have been smarter to sell everything, wait a year and buy back in full. I mean, would have been smarter not to lock it all, right? So you look at what I'm explaining, a lot of people create systems like if we don't have people staking, they will sell. That's not true. Why do you hold your Bitcoin? You can't stake that. You're holding it because you think it'll go up. That's why you hold it.
Just
You
wanted
think
to
it'll
say
go up.
that. Yeah,
That's why
exactly.
you do it. Nothing else.
That's it.
Doesn't matter. The rest of it's bullshit. I don't need to lock my chain link to believe my chain link will go up later if I believe in it long term, right? In the short term, it's volatile, right? So if I'm going to buy that so here's the thing. Why might I stake my chain link? Because I might not care what the price is this year. I might not care what the price is 2 years from now. I'm going to lock that and I'm going to ride it all out because I believe it'll be higher in 5 to 10 years. Who cares? Right? So I don't care. I'm not looking to sell my staking reward. So it's not like because they have staking, now I'm not going to dump. Because I have staking, I have another way to use it. Right? See what I mean? A lot of people do it the opposite way. If you don't have staking of some kind, we have no utility for the token. Think about what you said. You launch a token where the only mechanic is to lock it up for some unknown reason other than get more tokens. That's stupid. Why are you giving out all your money? What if I had a restaurant where the only way you can get food is to come in, put your food in there for free, and then I give you food for free? What the hell would that do? That's not adding any value. So you start thinking about what's going on. If I have a staking system and I have a utility token, what am I incentivizing people to do to get that reward? And that's why I don't like those airdrop farmers and all this kind of stuff. It's the same thing. You come in, you create your fake volume on there, you make your money, you dump on all the people that are buying the token to use it, sell your customers for all the fake volume, and then you hope you survive. But you look at your activity chart even a week later, even days, and you're down at nothing from all the volume.
Exactly.
Like, was that really a consumer base? Is that really customers who would come into your restaurant and eat there all the time? Or is that all fake? It's all fake because they're gone.
Exactly.
They're off to the next one.
Exactly.
So you did not market. One last thing I want to say. So on that end, did your marketing officer really market and bring in customers, which is the benefit, which is the purpose of marketing? Or did they look like they're marketing and bring in people who are just going to leave? So they look at it in the short term. What do they actually do? Because again, if we're looking to build a business long term, we don't want to have customer churn and lose customers. That's the opposite of how to grow a business, isn't it? In that case, you're doing something literally that every business that has tried the same thing has lost their customers and had significant churn afterwards. Literally, you're doing it again if you follow that. And by the way, you're giving all the free tokens to people who are buying that, which might be your first customers on that first day. Think about this.
Yeah.
Think about what kind of experience we create in some cases with these tokens, right? Your customers Want to use the platform the first day, buying tokens. Oh, why is my price going down? Oh, that's all the free people. They got all the free shit that's selling on you, John. That's why your token now you got obliterated today. The day you want to use the platform for this first time, that's why it's going down. All these people who were here before you, they're selling on you now. That's why you're down. John, you should have been there earlier. Well, you just launched today. I'm trying to use it. Well, John, you should have been here 3 weeks ago mining this, giving us fake volume so you get your free tokens so you can dump. Think about what we're doing here. That's literally it. When you think about the logic behind it, that's it.
Let's stop for a minute. For those who may not know me, my name is Nasib Fathi. I'm a scientific researcher in the blockchain space, and I'm a growth and media professional working with executives and organizations. My focus is crypto at the intersection of institutional finance, market structure, and regulation. You are watching the NFK podcast, where these topics are explored through conversations with people shaping the future of digital asset space. Do you think that this is a systemic issue in general?
I do.
Yeah.
And that's why, as a firm, what I'm looking at is how do you go to a company that has a real business that wants to come on chain, that has real customers, has real value, because they're not thinking like this. They're not thinking like this. They're thinking like a traditional business person might, right? As I think about it. When you look at most, it's like, all right, what's your plan for a business? Are you hoping to survive more than a month? If so, then your strategy doesn't align with that, right? So when you really look at what you're trying to do, that's why I think it is a systemic issue. I think it's a matter, but I don't think it's I also think it's a matter of people following what others are doing and just doing that all over again until it doesn't work, right? Like, for example, all the high FTV tokens that all the VCs invested in that were listed are now almost all of them down, 90, 95%. So if the value of the token, which is determined by the investment into it, was actually true, then why did it crash so much after the launch? If you had started with a lower market cap valuation, then we would have found that actually the launch would have been priced right or maybe underpriced because it would go up. In fact, we found in almost every case it was overpriced. Why? So people could dump and they can take money from it, right? So when I really look at what's happening, the systemic issue is greed, and also how people are framing this and saying, well, think about it again. We have a high fully diluted valuation. Why? I launched so the airdrop farmers get more money or else they'll be upset, right? If you have a low FDV and you're giving out 10% of the supply, you're giving out less value, right? So when you increase the FDV, the airdrop farmers now, they're all happy, right? Because they got more value, a higher percentage of tokens they're getting. Now think about this. I've seen people bitch because of the free money they're getting, right? And they're not getting a big enough airdrop, right? Why? Because they're planning on selling. They ain't planning on keeping all those tokens. They want to sell, right? So now let's think about this. You've increased the FDV to give tokens to people who just want to sell. So now all your customers have to buy in at a higher valuation and are more likely to go down. Pardon my French, fucking stupid. So again, this is what we're talking about, right? What if you could do it a different way? What if you launched at a reasonable valuation that made sense and you did take in tons of money and inflate your valuation and then just have millions of dollars so you could act like you're a superhero with all these millions, right? Why do you need all that in the age of AI where you have all these efficiencies, right? So how you take in enough money to build a viable product, you can get out into the market, have enough runway, ideally for a couple of years, right? Market and grow with a real viable product without having some overpriced token that we all agree is not worth the money that we're saying, right? Like, so for example, I believe Monad will go down over time. I believe that will happen. I believe Cato, another one I mentioned over a year ago, would go down over time. Now it's starting to wipe out. Why? Because all that's bullshit. Nobody wants to read a whole bunch of AI slop all over their feeds. No one wants, if you're paying some random guy to talk about your token all day, that's not bringing in a real user. I'm not seeing that and saying, oh, let me try this because this person's talking about it. No one's actually making a real decision in many cases off of the people that were talking about this stuff, right? So as I look at it, there's a lot of stuff that people are doing that actually isn't how real marketing works. And so as I looked at it kind of objectively, I'm of the opinion that over the long term, real marketing will always work. What does that mean? Building a real product. What does that mean? Going out and penetrating a market to get market share in that real product, getting the initial users in, asking them what they think, getting their feedback. You're just giving everybody everything for free. You just clouded your whole funnel with all this data, and you don't even know what your market is. You don't even know what worked or didn't work. And now you're going to think that after you launch and scale, you're going to start growing. You know what I mean? So this is kind of stuff I think about. Like, why are we trying to reinvent new ways of doing things that have historically proven not to work? You know, why don't we just do what has proven to work time and time again, which is building the product, getting it out into market, seeing what people think, the lean startup approach, and slowly building up from there. Why not do that? Why do we need to be all out here with these high FTVs and millions on the table and high risk? Why not start small? Why not leverage? That's what I did. Start small, get a market out there. So our community had only a couple thousand Telegram members in it at first, very small, right? And I'm in there every day talking to people, building relationship. Where's that leadership at today? Where's it at? Gone, right? So when you look at what people are doing, they might think, oh, I'm a CEO. I don't have time to talk to the community. I'm running this $400 million project. But you know what? The people that think differently talk to the community, right? That's the benefit of this, what we're doing. So sorry to ramble, but this is something I'm pretty passionate about, is how people are, from a leadership standpoint, operating here. So when I think about real business, you're not going to see that, because you're going to have somebody that has real estate assets that wants to bring it on chain to use in a different way. That isn't thinking like this, of thinking of selling their tokens next week so they can dump on everybody. That never even crossed their mind, probably, in a lot of cases. They're thinking about, I have these assets, I want to leverage tokenization and be innovative. How do I do that? They're not like, hopefully I can get my tokens and get investor funding someday so I can sell on these people. I mean, like, they're not thinking like
Exactly.
that. So this is why I go that much more that direction. Yeah.
I think we have a culture of value extraction and almost nothing else, right? And yeah, that's such a roadblock, because institutions, we need institutions in a way, right? Because that's the big capital that can fuel innovation, actually, which this space was always rooting for, right? But that's why they're hesitant, and it takes ages for them to actually understand how to use this, so that tomorrow and nothing will go to hell, right? And that's it's like shooting in your own foot again and again and again and again throughout the years. Yeah, and I think it's also a cultural error and issue as well.
Yeah. It's a matter of copy pasting what everyone else is doing, right? Like, so in what world is something worth $400 million without any market traction or even a product yet? You know what I mean? It doesn't make any sense, right? So you start thinking about it logically. You're like, this doesn't make any sense. And then I'm 43. I'm not sure how old you are, but I remember the dot-com bubble, okay? So I remember this stuff. I was 18. I was born in 1982, right? So right when that was starting to happen, I saw that, right? And I'm seeing a lot of the same things. Everyone's pumping up. Everyone's excited. But when you really look at it objectively, it all comes back to customer value. The companies like AOL at the time, why are they gone? Because they got replaced by all the cable internet companies, right? They're gone, right? But at the time, everyone was hyped over AOL. They got a new CD in my mailbox almost every week. That's how I think about it.
But in this case, don't you think that maybe it's just a part of a natural progression then? Because humans are humans, and they are the way they are. And it works almost literally the same every single time with any kind of
Yeah.
innovation.
Yeah, I think the biggest problem was the lack of regulation. So people don't know what to do right, and they want an idea, they just come in, right? So you have all these people doing stuff, and there's almost the excuses, well, we're just doing it. We don't have any rules that govern this. Now you're getting the rules, right? So when I look at that, I think that was also a piece of it, is you get this Wild West type mentality, which I'll be the first to admit, I love the Wild West. I love being in there with the throes of battle and the fire. You don't know what the hell's going to happen. I love it. That's why I work in this space, because I like that. But the part that was destructive was everyone coming in just to steal from people. Like, I had my own project. We had millions of dollars in there. I'm talking here. I didn't steal from anybody. My wallets, I don't give a shit. Find them. Some people have them. I don't care, because I didn't do anything bad, right? So you start thinking about what people were coming in. They're coming in and doing bad things. That creates a negative effect on our space, because now here's the thing. Before you buy, let's say, for example, you're browsing a line on X and you see a new token out there. What's your first inclination? Are you going to trust it, or are you going to think it might be a scam in many cases? Why have you been programmed that way?
Because of so many experiences, right?
Yeah. And you're not thinking. So the whole thing, all of our brains are built on pattern recognition. So, because if you had to think consciously about everything versus your brain automatically having the pattern recognition, you would go crazy and you would have to remember everything, right? So the whole point is, as time has gone on and we've seen scam, our brains naturally become wired to first question whether or not it's real or a scam. Now, here's the problem. You're a founder building in the space, and now that's what you get. Every time you might think you're legitimate and doing things correctly. People called me a scammer. And I'm like, what are you talking about? I woke up at 6. I shut down at midnight last night. I've been here all day. I didn't take any money. What are you guys talking about, right? You're a scammer until proven innocent in this space because of all the bad actors. So think about it. the space has been so bad that even yourself now just said the first time you look at something, you check whether it's a scam. Now, let me ask you this. When you buy anything in your life of any other industry, do you ask whether it's a scam first or yes or no?
Mostly no.
Yeah, right. So if we were to go on the stock market, start buying stocks, we pretty much trust those, right? We start thinking about our life, and we want something that people want to use all the time, right? We want this embedded in our lives. We start thinking about this. There's nothing in our lives right now that every day when we go to use it or we go to try something new, we wonder if it's going to be a scam or not. It doesn't exist, right? And there's a reason
But
for
on the
that.
other hand,
Something. Yeah, go ahead.
but on the other hand, not because when you asked me this question, I was thinking about this literal cases. I'm going to the grocery store and so on. But
Yeah,
you mentioned then stocks, right? Which is more connected to what we're talking about, to be fair. But when it comes to stocks, it really depends as well because stock markets has been abusive as well, right? But less abusive due to the regulations and due to those centralized exchanges. It's so very interconnected and
yeah,
it has been there for a while. Yeah, I get the point. I fully agree with that. But I also think that, we're entering the times when almost everything that is online product, and especially financial product, everything will be questioned,
yeah,
regardless of any market. But in crypto will be questioned first in a way, right? So,
yeah,
yeah,
yeah. You know what? That's a good point with AI. I
yeah,
question a lot of stuff now, but that's also why I think they
yeah.
need the blockchain because you don't know. Before this, I didn't tell you this. I had somebody send me a Zoom meeting link, right? A friend of mine messaged me on Telegram. Tony, you want to chat? I said, yeah, let's set up a meeting here, Pete. He's from Chicago, right? He's messaging me on
Mhm.
Telegram. Already had message with him. I get the message. He books the calendar through I book through his link. There's no meeting link though. I didn't notice it until I was about to join. So I'm about to join the meeting about a half hour before we started. Like I was telling you, I go on there. There's no meeting link. I message him. Oh, Tony, here's the link, right? He sends it to me. And in Telegram, it has a Zoom URL is formatted with the period in Zoom in the right spot, but the actual URL is not correct. So when I
Mhm.
click in that, I show him right there. I do a who is on the Zoom. I do a screen. I said, you're trying to scam me. Gonna send him a screenshot of this shit right out. And he instantly, you're clever. And he closed the whole chat and blocked me, right? So the point was, there's people, think about this. That's what's going to happen. So how do I know if that's a real Pete is really there? How do I know if that's really him? Because what they're doing is they record your video all confused and then they use you after they scam you and they take your Telegram, they message all your friends, and there you are on video. I've actually been on there where you see a person, you don't even know if that's them, but it's your friend. And it's them being confused from when they got scammed. That's what's happening. Right now. It's genius level intelligence, right? Because if
Yeah,
you
actually.
are sitting there seeing your friend and you can't talk to them, and you have an error message that says audio issues, and here's the script you paste in your computer to download the code, to fix your audio, and you do that, well, that just enabled the script, just pulls in all the programs and scans all your computer for private keys. And while it's doing that, you can't hear. So it looks like your audio is not working. So you're sitting there confused, right? So that's recording you. And then after they hack you, they have a video of you confused on video they can use and message your friends. And it all starts all over again and it networks from there. So you end up with thousands and thousands of fake videos of people you know with their Telegram accounts controlled that you can message and set up all these meetings across. That's what's happening, right? So we will, like you said, reach a point where you don't know what's real,
Yeah,
unless
yeah.
you're smart enough to kind of figure out, but that. Was a tough one to figure out.
Liquidity incentives assume capital is mobile and rational. Where does that assumption break once liquidity providers are driven by reward loops, right? Rather than fee economics.
Yeah, I would say, well, that's basically, if you remember the farming days from a few years ago where we had a lot of farms and DeFi farms, that's where you saw that in action. So what ends up happening in a lot of cases are these liquidity providers were all in these farms thinking they're making money. So how it works is you take your USDC, take your tokens, put that in, and then you create liquidity for the token. Then you have those LP tokens that come back. Then you lock those in the farm, and then now you earn tokens. But you think about this, what you're doing is you're just earning emissions that are the same token that you're locking in there. There's no value of that, right? So what ends up
Mm-hmm.
happening is this can work for a little while until the actual Ponzi starts to unravel, right? Because at the end of the day, if everyone is locking their tokens and earning emissions, those tokens are also being minted. That's creating more value, like the market cap's expanding. So when you're locking that, that's showing TVL is growing. But TVL is growing by a function of the tokens you're releasing and emitting and a portion of those that are unlocked versus sold. right? So what you're doing is you're basically increasing your own TVL by emitting all of your tokens, and it's a game of liquidity to see who will sell first, right? That was a big part of what went on in the farming meta, I would say. Now, as I look at liquidity provision, I would look at it in a different way. In these days where we have regulation and you have morpho vaults and a lot of different ways that you can kind of be incentivized, I would say you'll see a lot less people taking the route of let me be a liquidity provider for a token and take both sides of that and take all that risk of a permanent loss. You'll find a lot more of people saying, let me take my liquidity that's here, that is a stable coin, whatever, lock that into some protocol and provide liquidity there. I think you'll see a lot more of that kind of going on, especially with regulatory, right? Because you have private credit, a lot of different vaults and stuff coming on chain. So that's where you'll start to, like Huma Finance, another one with private payments and stuff, PayFi. So you'll start to see things like this. Now, Huma cannot pay anybody if it doesn't have liquidity in the vault, right? So you'll see like this type of thing where it's actually powering real business instead of your liquidity is an incestuous relationship like I just explained with the farm, where everyone is just waiting to see who's going to sell first. I literally saw one in the bear market. It was crazy, going up, 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 up like this. And then in one day, some farm guy decided to sell, and it crashed 90 million in volume off the DEX in one day. It was a massive liquidation. I assume the insiders made a lot of money, whoever was in there since the beginning. But anyone came in afterwards, right? Eventually, it's going to break down. Somebody decides to take your chips off the table. And as I showed you, it doesn't take much liquidity to crash, right? So that's an example.
Exactly. Yeah.
Those kind of relationships are bad, those types of setups.
But which signs or signals tell you that liquidity is structurally stickier rather than rented, and how early can you detect that?
Yeah, I think you can look up the lockups. So are you willing to lock or not? So that's a big piece of it. You can also look at individual wallet analysis as a piece of it too. Like when we mentioned when I was working on a recent project that had a payment system, we pulled the Huma Finance data and we looked at the vaults for that, right? So I think you can look on chain data and kind of see how people are performing now is a great way to kind of analyze psychology of how people use different systems and things like that. So that's how I generally like to approach it.
How do vesting schedules and time-weighted rewards alter behavior compared to instant emissions, especially under volatile market conditions?
Yeah, I would say like if you have a situation where you have like a lot released on launch, that could work if you have a lot of marketing, you have a lot of volume and distribution, you can wash out a lot of that. So everything that I look at when it comes to tokens is a big function of the kind of that speculative volume in a big way, right? Because if you release too many tokens too fast and you don't have any buying pressure to overcome those, then you're going to go down, right? So as you look at everything, it's kind of like a function of what you're releasing as in the time frame you're releasing it, and you need to have adequate buy pressure to overcome whatever is being released, right? So as you look at the difference between those two, we might have, let's say, 1 million tokens releasing next month. But if we know we have every month we have a lot of buying pressure, a lot of demand, a lot of volume, it might not affect us that much if that makes sense, right? Now, when the market starts to become less liquid and we have less liquidity, we have less volume, now those tokens starting to be released, that could be more problematic. Why? Because you don't have enough volume to even overcome some of the potential selling pressure. Then that could again create the negative downside pressure, right? And the dips. So that's why liquidity is really important. Last thing I'll say too is how much liquidity is inside of the pool is another piece that's important as well, because obviously if there's thin liquidity there, it doesn't take much selling pressure to start to decline the price in that end, right? So I really believe like understanding liquidity and the market conditions, this is a really big piece of tokenomics. It really is. And it's also a piece that is more outside of the control at the time, right? And so like I said, the piece that is in our control is the sustainability, market cap that you launch at, right? There's a lot of things we can control. There's also a lot of things we cannot, right? So whenever you look at a token, this is the thing I look at. You cannot say, well, the tokenomics, that person did a great job. That's why it pumped up, right? You can't say that in all cases, nor can you say that they did a bad job if it dumped out, right? Because the whole point of what I'm saying is it depends on sentiment. There's a lot of different pieces to this, right? For example, maybe the CEO just announced he's going to jail. Now you go down, right? There's all kinds of stuff that could happen. Maybe the product had a major issue. That could fail, right? So there's all different things that could go wrong, right? So I just want to frame it too. I don't like it if people think this is the end-all be-all solution. It's a piece of it. There's a lot that goes into psychology of a token price, and a lot of it is in your leadership and whether or not they believe that you're going to be around delivering, right? Like, is anyone buying Aster right now? I don't know. We were before. I don't even hear about it now. Is anyone still buying that? So, yeah.
By the way, what do you think? Because I wanted to actually ask you about this. So, what do you think about Aster and alike, right? So, is there still a future in this?
Well, I'm one where I personally do like Hyperliquid. I personally do like that. I don't
Mhm.
believe we need. I don't like the Aster, because I think there's some stuff going on there that probably was not the most above board. I don't like how fast it sprung up. CZ promote. I think there's some stuff going on that I don't like. But I would say at its core, the DEXs, perps and stuff, I think that is around to stay because people do love that type of trading. And it also enables trading without having, like I mentioned, the liquidity pool issues, like I said there too. It gives you a different way to trade, a new unique way to trade. The part that I am worried about is the people who don't know what they're doing coming on and using leverage and not understanding how they can get liquidated and these kind of things. I believe that is all the influencers that have promoted things by sharing these screenshots. Like James Wynn is another one. Showing screenshots of making millions. You hear him on an AMA, guy can't even string together 2 sentences. This is the thing about it. In text form, this is the genius we're following. In audio form, this guy deserves. This guy should be back in first grade.
It literally takes one time to go on Spaces to listen, and that's it, right?
Yep,
So you
exactly.
make your conclusions. If you're an adequate human being or just like on a very basic level, that's it. Your perception of the guy changes completely. So yeah,
That's it. That's what I'm saying.
and
So,
there are reasons for that.
yeah. So there's people like that were promoting how much money they were making, but now look at it. They got wrecked, right? And there's people that followed them that also got wrecked. The
So
anti is another
Spaces
one.
So
Yeah.
Spaces isn't really always the right way to go, right? But because I bet if he would just stay congruent with his initial plan, right, initial tactics, the whole perception would be different. Regarding Andrew Tate, yeah, that's a different story. But the guy was admitting a lot of stuff even years before, right? So I
Yeah.
mean,
All kinds of craziness. So
yeah.
that's what I think about them. I think they'll be around, right? But I hope they get used less because there's a lot of chaos and stuff that happens as a result of people and all this leverage. Like, look at all the liquidations we see. We never used to see that. That's unbelievable.
When designing liquidity pools, how should teams think about the trade-offs or trade-off between depth and volatility rather than maximizing TVL?
Yeah, I would say, well, let's think about TBL. If you maximize TBL in the decentralized exchange, why would you do that? Because you're just having all your liquidity locked up in there. And it takes a lot more volume to pump your chart, right? So as I look at it, there's always a balance of, first of all, do we have enough liquidity in the pool? I'll give you an example. There was one project, not going to mention names. They had a $25 million market cap. There's only $25,000 in liquidity pool, and they're marketing like crazy. And I showed them, I said, you know what? If I go to your DEX right now, I can't even buy $5,000 of your token without a warning on Uniswap. And you guys are marketing all the time. Like, what are you guys doing? And then furthermore, why is there only $25,000 here? Who budgeted for this? Who ran the math and said that this should work? And there is math you can run because we run it. And so what we'll do is we look at, all right, what's the market cap? From that, we also establish a reasonable budget of liquidity we have available. Okay. So, and if you tell me you only have $10,000, that's not enough. I don't care, right? You have to have a reasonable budget for liquidity that has to be there linked to your market cap. What you can do next then is, because this is all math, you can stress test. And what I'm going to say stress tests, what you're going to look at is primarily the slippage on the trade, right? And the reason why I mention that. So if you have, for example, high slippage on your DEX, that means you have thin volatile liquidity. What that means is when someone buys, it's going to pump the chart a lot faster. And when they sell, it's going to drop it a lot faster, right? If you have too much liquidity, in my token at a $200 million valuation, I have $30 million inside of there. That's way too much. That's a lot. And so now when someone sold $500,000, it made a small dent in the chart. It's like, holy crap, it hardly did anything, But if someone bought $500,000, also a small dent in the chart, right? So you start thinking about this, it's like, the liquidity, as I'll give you the greatest example, is I'm not really a very strong guy, right? Now, if I have a lot of liquidity, I can't lift a lot. It's hard to raise the price. If it's a light, I can lift it, right? So, but you also want to make it so if I can just lift like this, I'm not doing anything, right? So you have to make it so you actually have a state where it actually makes sense. And how I'll look at that is if, for example, if you have a $100 million market cap project, I should be able to buy 20 grand. Okay. If you have $1 million market cap project, 20 grand might not be feasible in the very beginning off of a small DEX, right? Because it takes time to build that pool up. So the way I'll look at that is we will analyze that using statistics, and you can check all the liquidity and the slippage. So we'll create a whole report that shows on a $5,000 buy, this is the slippage. On a $10,000 buy, this is slippage. And there's a reason also for this. If we've seen the sandwich bots like Jared from Subway, what they're doing is they're buying in low liquidity environments. They buy in, the bot will buy in on the same block. Then your buy comes in on top of theirs, and then they sell right after that. So what happens is they buy in, you buy on top of them, and you shift the price up. Then they dump on top of you, and they take the difference. That's a sandwich attack. And that happens in low liquidity environments because of the volatility. It can happen. Okay, and so this is the kind of stuff that's going on, right? So if you have thin liquidity, you might see all these bots on there. Why are they there? Because you're enabling them to have a feast that they, because if you got buyers coming in, throwing in $5,000, throwing in $10,000, the bot's going to be there, right? It's going to wait to buy right before that. You put your $5,000, pump up the price, it sells it, it extracts the difference, right? Because when you buy, when you see that price go up, you're buying wherever that chart candle is. That's where you buy your swap. So for example, if I have $100,000 and I got $1 million market cap and I put in $100,000, the price of the market cap doesn't become 100, $1,000,000.1. It becomes a lot more, right? Because it moves by that buy. But the price I core my tokens at is at the top of whatever I created, right? So if you're not a very smart whale and you want to buy in a lot, like I've seen people buy it, right? These whales, they buy in a huge green candle and you'll see all the community dump on top of them and take all that money back down, right? That's what's happening is they bought too much, big green candle, too much volatility. They bought at the top of those candles. They've lost money and all the community now sold back on top of them and taking that liquidity, right? So that's an example of like low liquidity environments create these types of issues. So you have to do the math and kind of work through the numbers. And again, if you're, market cap of 100 million, then you're going to want to take in larger buying per buyer volume than if you're a $10 million as an example, right? Because you got to grow up to these different levels essentially. Whales generally will not stop even being interested even in a more DeFi degen environment until around $20 million market cap. That's when they start coming in, right? And the reason for that is there's not enough liquidity there for them to get a good buy-in. That's why. Okay.
Do weighted pools, dynamic fees, or multi-token pools meaningfully reduce impermanent loss at scale, or do they simply redistribute risk?
I think I'm a big fan of kind of more simplistic models. I think a lot of that is too complicated. And I also believe I just like to keep it simple. Like, can I have it where I can just lock my both pairs and have it work like a normal pool will without all this fancy mathematics? Because at the end of the day, it's only worth whatever money is there. If I only this is the way I look at it, right? So the more complicated, the more I think you're trying to hide something, right? Because here at the end of the day, if I only have 100,000 there, that's all the value that's there. I don't care how you move it around. There's only $100,000 of value there, right? So how you do the math. Now here's the thing: how we actually move, like Curve is one example where it has different formulas and stuff, right? They're doing different things, right? But when you look at how you might even have a way of moving where the chart, how slippage adjusts, that's where I kind of like how those are set up. I think we need that because, again, it is hard to figure out how do you put together the pool and then to have the pool kind of survive and to take in a wide variety of different buying types. When you're on a centralized exchange, you have the order book, it's different, right? So in this case, this is literally just trading with the pool. So it creates a different way to operate, right? So again, to sum up, I'm not a fan of complexity. I'm a fan of simplicity. And I want to make sure that the money that's there is being still utilized correctly and it's creating a reasonable valuation. That's what I like to see. I don't like to see 100 grand in a pool. And because we have these fancy mathematics in our DEXs, now we can be at a $10 million market cap with only 100 grand here. We save money. I don't like that because at the end of the day, that's what will fail. Is because there's only 100 grand there, right? So that's what I just say is like, I'm always a mindset of let's figure out what real value we have and how do we back our token with that value and how do we start? That's how I like it, no matter what the fancy math might be. And also some of these things are also not really that proven. So you're tying your token in some cases to some of these things that might even fail. Who knows, right? So that's why, again, still today, I'm a fan of kind of the Uniswap V3 type, V4 type model. That's what I lean more towards than trying something that may be a little bit out there. That being said, I am always interested in seeing how things work and new technologies and, because we're still just very early here still. Uniswap was made a long time ago, and with the original constant product formula, and it still very much exists in a lot of ways, very similar today, so we do need innovation at the same time.
But what you have just said also signifies the establishment of the industry at least in a certain form, right? So we actually have something to lean on by the end of the day. That's also good. Let's talk about reward loops a bit. Reward loops are powerful, but definitely can be dangerous. What distinguishes a reward loop that compounds value over from one that accelerates extraction?
Yeah, I mean, I've did a post on this, so it was a while back, but I basically had a machinations diagram I built where it shows the
Mhm.
rewards kind of going in, and you've got two branches off of there. Branch number one, these are the sellers. Branch
Mhm.
number two, these are the people that are going to hold, right? So that's really as simple as you think about it, right? So if you've got a rewards
Mhm.
loop and you've got more people locking than selling, you're going to have an increase over time of that, right? Now, here's the thing. Those people selling, you need to
Mhm.
overcome that with some kind of buying volume, right? So if you don't have that, that's an example where, let's say, for example, I give out $1 million and 50% of the people sell and 50% of the people hold. I now have a $500,000 selling pressure thing I need to overcome, right? So how you think about the rewards is really going to be like, how do you incentivize people to keep them and to do the right thing? And then also, the reward, what are you actually rewarding that created value? And that's the reason why I mentioned the airdrops. That's actually not creating value if somebody just pulls all their money and leaves, because that was just, mercenary value, right? So when I look at a reward, how did that reward actually create real value? I'll give you an example of the video games. I'm a big gamer. I got this, all throughout my shelf here, the games I'm kind of there, right? And when I look at even play to earn gaming. Okay. In my own project,
Mhm.
we had the game that we did, and you had an earn mechanic with it. Now, with this, at the time, everyone was making it where if you play the game and you get tokens and stuff, you can sell those. So if you think
Mhm.
about this, as you scale your players, you also scale your selling pressure, right? Because you have more rewards for more players, right? So my
Mhm.
goal is
Mhm.
to have as many players as possible. Guess what's going to happen to your price? The more rewards you give out, you're going to be destroyed. And so I had already been through my own tokenomics challenges. By that point, I had to make that decision, and I was not going to go back again. And so what I did differently is I said, well, wait a minute. What if as you played the game, you got points and coins, but these were virtual things that were in a Web 2.0 type database? And what if now you could bring those into 1155 tokens on chain? So I built a real way to kind of bridge that off of there. And then now you have these tokens on chain, and then now you can use those in our virtual raffle. So now you have something that now for all players that might only have 10 great prizes that's more scalable. And they enter by playing the game and getting coins. And if you have a better character, you get more coins. So you have an advantage there.
Mhm.
But nobody is able to scale the selling pressure through those means. And I'm managing that every time we do the raffle. Right. And then now the game, I'll just tell you, actually sucked, okay, because it was really hard to get it done. And the guys that we were working with, Cubics, I'll mention their name, don't ever use them. They delayed the job by about by about double what they originally said we would use.
Mhm.
So the whole point is the game wasn't that good because it didn't come out in time. I didn't have hardly any time to change it. I mean, but here's the game changer. The community every month, millions of raffle tickets through the raffle. They loved it, right? So the whole point is how you think about rewards is really the people that you're looking to incentivize. So you don't always need to give out a token as reward. People can get rewards in different ways. If you get recognized, you get a badge in a video game. Like when we think about rewards, we've kind of taken in Web3, the only way to give anyone any kind of incentive is to give them free money. And then anyone in
Mhm.
Web3 who comes in that doesn't get free money, is expecting free money, is upset. Get what? Guess what? Get the hell out of here. This isn't your for you. You know what I mean? That's
This
how
is
I personally
yeah,
see
yeah.
it, right? So you kind of see like who's coming in and what they're expecting, the rewards. What are you actually giving it for and what do you want? In that case, we gave out the rewards, which were the raffle prizes. People got to play the game and have fun with it with their friends and family, compete against each other. And on my end, every month I would give out the prizes and I wasn't selling myself into the ground every time I did it. You know what I mean? And I had a scalable system at the same time. So when I look at a reward, I would say disrupt the thinking that a reward can only be a token. A reward in that
Mhm.
case could be a chance to play the game, to compete with your friends, to get into the raffle, to see if you might win a prize, to attend the monthly drawing. That might be a reward. That might be something your customers also like participating in. And even if they might even invite their grandparents, like I had in my case, I had grandma and grandpa there, the father, and his wife as an example, the kids, all of them on the community watching the raffle, right? Like so, if you're building a community, fun oriented project, and that's the result you have, that's a reward for people. That family probably had a great time getting together and doing that, right? So when you think about a reward, again, let's get away from it always has to be a financial thing. Let's look at our customers. And if we give
Mhm.
them something they value, that's a reward. In that case, it could be a free pet like we would do in our community. Here's your free NFT. You got it right there, right? I would give out things for my own wallets, right? So when you think about what we're doing, I just want to emphasize again rewards. It doesn't just have to be tokens. It doesn't just have to be emitted blindly to everybody. Rewards should be based on your company and how you incentivize your customers. That's what you should do. And I think a lot of people get into a frame of the only way to give a reward is with a token. That's only because, again, it's an incestuous industry where the only people who were using platforms had tokens. Here, we're talking about someone outside of this. So if I went to my dad who's 70 and said, here's my product, he like, where's my token rewards? He wouldn't even think about that. See what I mean? Look at what we've created from a pattern, again, a human pattern standpoint is now you're using blockchain with tokens and you're an early user, you expect free money, but why? What did you do? Why does that have to work that way? It doesn't make any sense. How does that align with our strategy? Now, if that aligns with your strategy to give out some free tokens to get people to use the software for free, like an example for me is Whisper. They gave me a 14-day free trial to use the software where I could talk and then it types for me. This is almost double my productivity, right? It's insane. So now they gave me the free product. I'm using it. I'm sticky in there. And guess what? When it came in for the annual purchase, I bought the thing, $150, done right away, right? So when you think about a reward, what are we rewarding and how are we doing it? And how is it driving the value to our customers? In that case, the reward there was 14 days of free usage. By that point, I was so sticky with this thing, I wasn't leading. Yeah, you're going to charge me $12 a month and double my productivity through speaking of something versus typing, and I'm on the computer all day, sold, right? So when you think, so that reward got me into this, which showed me the benefits, which made me sticky, which I bought, right? So when you look at the reward, what are we actually trying to get? Are we trying to give people free money, or are we trying to get a business result? And how did you tie the reward to the business result? Right?
Or an experience, right? As in the case of the play to earn.
Still it's a result, right? Because you're with your customers, you're creating an experience, right? An engagement with them, right? I want to get to that mentality where that's how business should be done. Not a whole bunch of nascent people join your Telegram and getting free shit. That will not work. It should be built the right way.
I wonder because I believe that eventually the system will exist, right? This in-game token economy, and at the same time you can sell those tokens in real life, but at the same time in a way that will not create this crazy selling pressure, right? So from one side there is this thing that you mentioned, so providing a better experience, so the reward systems like in your brains will of users, right, will work in more natural to gaming way, right? And at the same time not crush the business itself. But how to balance that, right? Do you have any
one that we did it? Yeah, I'll give you one where we did it. Okay, so there was a GPU like a company that had decentralized GPU storage we were working with, okay? And so now what happens is you want people to use the GPUs so you have activity, and then now you have traction, right? You can help sell, right? You need to get your network going. So what we did there is whenever you use the GPU and you're paying for that, a GPU provider definitely gets tokens and money for doing that, right? They're being paid to do that. So you have someone who wants to rent the GPU, they're paying the provider to do that. Now, when you do that, you actually get tokens as a credit inside of your system. Okay, so you get tokens you can only use within the system. Okay, now here's the thing. So you will see a virtual credit inside of the system after you bought some GPU power. So you've spent some money in the system. Now you see you have a benefit on top. It's a credit. It's not the actual token. Now here's the thing. When that is used again, it'll pull the virtual token, remove some tokens from Treasury, and use that to pay the GPU. So what have I done? I've used the credit that's there, and unless they're using the system, you're not getting anything. So I've driven the actual demand of a user who would use the GPU anyway, and I've given them a benefit for being an early user, right? And so how I look at an example of a sustainable reward in that case, that user cannot take that and sell it, because what will happen is they're going to take it, buy some GPU power, it'll randomly pick a GPU host, find them, pair them together, and pay that GPU. So it's not like I can even program which ones I want to give it to, right, through the Treasury, right? So when you think about a reward in that case, that user now that's early, that is participating with the early credit system, lowered their cost now of GPU renting, right? So we've given them a value. And we've also shown them how before and after using the centralized GPU, before and after, it was about a 60 to 70% price decrease. So now you get a 60 to 70% price decrease from centralized approach, and you also get credits to be an early user, right? So now if you're thinking about marketing, how do you market now to companies that are paying a lot in GPU? Think about what I just said. We can lower your costs by 60 to 70%, and we also will give you 10% free credits or whatever it is as you use the system. Now I've brought them into a system, get them to use the token. Ideally, if they use the token, they get the credits. If they use dollars, they don't. So now I brought them to a state to get them to want to try and test it and use the token. See what I mean? A lot of people don't think like this when they're building the product. They think, well, if you have tokens, you get a discount. Well, how do they think about onboarding? How do they think about the company in that case that doesn't have even an institutional account yet for banking? They can't even buy tokens and use them yet. How do they think about that person's journey, right? How are they even going to get into it? See what I mean? When you look at business, a lot of people don't think like this. And that's the biggest mistake I keep reiterating. People don't think like that. In that case, the reason why I thought like that is I recognize that if you're a larger GPU, like a company like Replicate is a great one. They're doing a lot of GPU a month, using a lot. So if you're a company using a lot of GPU and now we reach out to you with all the benefits there, why do we even have to talk about all the tokens and all this Web3 crap? If I just led with that angle, right? Because wouldn't I care more about the discounts, right? If I'm in this, right? And I might not believe it at first. And that might be why I have a free trial to come in, right? And when I start thinking about the sale, see what I mean in the sales, I just recognize you smile a little bit because you're realizing how bad most companies think about selling and marketing and business building in this space. They don't think like this, and that will not work. What will work is making real money by solving real problems, right? And so that's how I kind of think about it. In that case, we designed something specifically for that audience that would enable reduced costs and a strong marketing message, right? So that's an example of how to think about things a little bit differently than what most are kind of doing in this space.
Also, a challenge to explain that to the users in the play to earn, for example, again, space. How to explain all these things to the teenagers, right? On the other hand, we had a lot of teenagers rocking the economics of World of Warcraft and so on, right? So also existent, right? But here, anyways, coming back to reward loops and user retention. So how do you align reward loops with platform goals without over-incentivizing low quality or Sybil-driven behavior?
Well, Sybil-driven behavior, remember, is just a lot of it's a function of enabling the things they just said. So, for example, if I don't want Sybil's to farm my airdrop, then I should not have an airdrop where they can farm it like that. As an example, if the only way you can get a reward is by buying and using the system, right, then you will buy and use the system. I've prevented that, right? So when you look at what people are doing, the reason why they have to prevent Sybil's is because they're not actually incentivizing real customers in many cases, right? So they're trying to give away all this free money and prevent people from making too much free money by mitigating Sybil's, right? So you really look at what they're doing in the beginning. If I were to go way back to the beginning, I would ask why we're even doing that to begin with. You know, like what's our, so the question is, in our marketing approach, how does that help us get to our goals? If we look at that, right? And so that's how I'll always look at it, right? So if we tie that back to how it's helping us get to our goals, I can understand how much we might be giving out to onboard the system. I will say, in some cases, having the airdrop to onboard your initial system, your initial users, if you're going after the right market, that could be good, right? Because people like free samples and free food. There's all kinds of things like this that work. But unfortunately, in the examples you're giving, they're giving people a taste of free food they never planned to even buy. You know what I mean? And so that's the problem with it, right? So as I look at it, you want to figure out this is the reward, this is the incentive they get, and this is the value it creates for our business, right? If you think about these things and tie them together, now anytime you're giving out a reward, you'll be able to answer the question of why, right? Because if I ask now, most projects, why are you doing an airdrop farm? Well, we have to, or else no one will use our protocol. Well, wait a minute here.
Then what's the point in the first place?
It's good, right?
Yeah.
Right. Why did people use ChatGPT? Because it kicked ass when it first came out. It was really good, right? That's why they used it. It's a good product, right? So, and granted, yes, you need awareness. And yes, sometimes a still financial product is hard to get people to use. You know what I mean? But the whole point is, I think you got to go back to real business and back to real marketing instead of copy pasting every strategy that usually ends up with the protocol having no use. And I'd love to say it works, but I've found in almost every case where you have these short-term rewards for early traction, it just dies out afterwards. Everyone sells off, people make free money. And the downside, as I mentioned, is the people selling might just be selling on the very first customers of the platform, because usually the distribution is the first day for the airdrop, right? So literally the first day, all these people get free money that want to sell and leave. You have new customers coming in who want to buy and use it if you did the right job of marketing, right? If that's your launch, that's your launch. Shouldn't you have people coming in new that day? Yes, I believe you should. So on that day, you've got the people selling on you that you gave the free money to that are killing your first customers. See what I mean? This is, and I hate to overthink it, but I think we almost need second, third, fourth order thinking in some cases on what's actually happening. Because like I explained in that scenario, Someone might just say, well, that's how you have to market. No, it's not. No, it's not, because a lot of this was platforms were marketed before. You had the founder going on there. They were doing AMAs. They were building relationships. They were always talking. Now you got people that want to copy paste the rewards distribution, and then now you're saying that's the only way to do it. It's not. There's many different ways to market. Marketing is bringing awareness of the product to the right market, right? If you can do that, you got a great product, and you can incentivize them to come in. That should work. You should not have to give out free money to everybody to use every single platform. Right. The other thing I'll say is when you come to early liquidity provision, this is a case where you have to, in some respect, consider rewards, right? So for example, if I have an empty vault, I might have to have an early token earning to get liquidity to come in because I need to be competitive and benchmark with other platforms, right? I need to bring that liquidity to me. In that case, that's still a matter of always working through your KPIs and saying, you know what, this is why we're doing it. If we can get this much liquidity, then we can give out this much rewards. Then we can correct this much in fees. We can keep growing, whatever the case might be. You have real business fundamentals you've mapped out that makes sense. That's why you're doing that. And you're also making sure that, again, it isn't like mercenary from that standpoint. Because if you're doing it for that reason, the short-term pull liquidity, after that leaves, they're all going to leave anyway. You didn't actually acquire a sticky customer. You lost them, right? So as I think about it, sometimes the early stages of come in, be an early LP, lock up your liquidity, participate with us, get rewards. That works very well. The ones I'm saying do not work, and you've seen them, are when you give out hundreds of millions of dollars of free tokens and all these huge protocols, and because those just end up decimated, right? And it doesn't. And the reason why is, let's go back to kind of the fundamentals. The only reason why it worked is because of the free money, right? It wasn't kind of set up like I'm saying, and this is a better platform, this is a better yield, it's safer, it's more regulated, it's got a better team, whatever the case might be. This is where you want to park your money. Instead of an Aave, park it here. You'll get a higher yield. You'll earn some tokens early, right? This is how to think about it.
Let's talk about treasury management and capital allocation. So DAO treasuries increasingly resemble endowments. At what size does passive treasury management become a liability?
A passive treasury management, like not having an actual CFO, I would say you should always have a CFO managing your money. Reason why I would say that is, in my case, we had like a good amount of capital when the market started to crash. So our whole treasury, literally you wake up, it's down 25% in a day. That's tough. So I would say, like, from a management standpoint, you always want to have that, because no matter what you have in this space, it can go down pretty quick, right? So if you're in your altcoins, you got the CFO managing the risk and checking this, they'll be able to give you some good suggestions, right? So I think always, even when I had my project, everything was always managed like a business, always properly. You want to make sure you have clear budgets. You got your treasury there, you know what you have. The thing I would say from a token standpoint is, do not count on tokens being worth money later you can sell, and that is fundraising. Because you don't know what's going to happen 3 years from now when those tokens, or even a year from now, those tokens emit and they release, like Barachain, down 95%. So what used to be $1 million is now 50 grand. That's tough. Yeah, so you really want to think about like your treasury allocation, right? And not really bank on a lot of that. You really want to think about how to make money. How do you make money? How do you save money, right? You need to have someone with financial in their head, or else you're going to lose a lot of money very quick in this space. So like, even somebody who can say, you know what, we shouldn't spend that in that marketing campaign, that influencer campaign that they want 100 grand. It's just going to put a bunch of Lamborghinis in Dubai that do nothing for us. Let's not do that. You need somebody who thinks like that, right? That says, what's our result that we're going to get off of this? Like, that's what I had. I had a CFO, and this guy used to work for, well, at the time he worked for Neuberger Berman. He's, and this kind of stuff. It's one of the largest asset management firms in the world. That was my CFO, was a VP of one of those companies. So when I got in there, everything organized, all the budgets, like, that's how you want to run something. You're running a business. What I found in the opposite, a lot of teams unprofessionally say that we have all this treasury, everything else, they'll find that it's quickly gone. I've been when I left my project, I joined short-term an NFT project, went in there, the whole treasury was buying NFTs, art blocks, all this. I found all the team was doing all that. So I've tracked all the wallets, and I said, you know what, I'm leaving this company unless tomorrow I wake up and all the money that I just found is back in the treasury. And they said, it's not that, it's more complicated than that. So I said, no, it's not. I found it all. It's right here. Push it all into the wallet. That's it. You can do it right now. I woke up, it wasn't there. I quit and went to Disney, and that's when I started this consulting business. Was right after that. But this is an example of people mismanaging treasury. Again, buying NFTs, pushing it all out. You need somebody who's managing that, and somebody with ethics and integrity that is going to call out all the crap and all the bullshit and say no to things. That's what you need. I don't care if you got 50 grand, you need somebody doing that, or else you'll have nothing soon. especially in this space.
What role should simulation tools play in treasury decisions? Because you already mentioned simulations before, but what risks will still remain invisible? Even, yeah, will remain invisible without them?
Well, I would say like treasury is just budget management, right? So do you actually have a budget? Do you have a budget for your project, your company? What is that budget, right? So whenever I hear like mismanaged treasury or whatever, you always go back to what was your budget and did you actually have one written down? I have one.
Yeah.
So do you actually have it written down? If you don't, then expect to have it mismanaged because you don't have a way to manage it. So that's how I kind of see it, right? So if we want to have if you want to have good treasury management, then you started in the very beginning with clear processes, controls, everything else. And I don't think you can kind of simulate your way around a treasury because you don't know what your costs will be, right? And that's why I go back to a budget. I believe the best way to operate is to look at your cash positions. Again, not tokens and OTC deals later because that could not work. You're banking on something that might not come through. So you work off the real cash. How much money can you actually make? Again, you have to make money, make revenues because you're a business, at least if you're building here, make money. Then how does that work? Again, it's traditional business. And the thing that I dislike is because now we have a token, we can eliminate a lot of the things that traditional business does. Well, you know why you do those things in traditional business? Because after thousands of years, people have uncovered that this is the smartest way to run a business is these tools. So for example, if you want to run your business without a budget and you have, a treasury of $50 million, then do not be surprised later when you have no clue where your money's going and you have no management infrastructure around it, right? So I would say, yeah.
But as treasuries grow, do DAOs inevitably drift towards centralized financial management?
Well, I think in many ways you should, right? If you're talking about DAOs specifically versus like an actual company, right? Because I think we're also going away of everything needs to be a DAO or Cayman Islands Foundation with BVI entity. I hope we are. So if you go that route, then I believe you need active community management and governance. Like we saw Aave have a lot of problems with that, right? So I believe like how it starts off should be how it's managed. Like as an example, if it's a DeFi protocol that makes its own revenues, then I don't believe you should have a whole bunch of voting on where money goes, right? It's a treasury in that case, right? I believe that should be the stakeholders there should be using that to grow the protocol. And then the community should see how they're doing that, right? I don't believe you should have a vote if you want to use some money. Now, when you get into other systems like a MetaDAO, where they have a DAO that manages that treasury, that has a monthly pull the team gets every month. That I think is a good model if you're going to want to go over a more active treasury management route. You can go the ownership coin route, have X amount that you raise, then you have a monthly budget you can pull. And then if you want to pull more or raise more, you have to vote on that, right? So that is one way that, again, you can wall off the constraint of having it so the team doesn't take all the money and walk away, which happens a lot in this space. Every month they're going to get more to keep building. They've had to present their budget and communicate that to the community. That's a great example, MetaDAO. That is there, and every single month they know they can pull that through the smart contract. That's there, and if anything needs to change, it could be voted on by the token holders, right? So that's one example. The other one would be if you have a DAO where you have a treasury and all the token holders can vote. I think, so again, it depends on how you're starting the whole thing up. If the original intention was all the members can vote on certain things, such as spending money or whatever, then you have to abide by those guidelines. That's how I see it, right? So I think you always have to be as transparent as possible of what the token allows. If I have a utility token, I don't expect to have a whole bunch of governance with that unless they give me some special cases where I can apply governance, right? I don't expect it by default. If I have a governance token I bought, then I expect governance and control, especially if it's attached to some DAO of some kind. If that makes sense, right? And the last thing I'll say is I always believe you will still need a level of centralized control. Like as an example, if I say, well, the DAO can name my child anything, I might not want that. I might want to have a few options to give the DAO to choose from. So when you think about like what can happen, that's what I'd say is I believe you will probably need some human leadership who thinks through, creates solutions that even the DAO could vote into that then distills the things down. Like I'm a Freemason, and that is an organization that's been around for 200 years. Okay, it's the world's oldest and largest fraternity. So in that end, every year we have a progression of people who move up. We have voting. So all new members who come in can get voted in, yes or no, right? So you have control over who can come in. So the risk for a DAO is you don't know who's going to be there too. You might have a bad, I just know the Freemasons, I know who's there because if you don't get in, if someone votes no, you don't even get into the process to get in, right? They call it being blackballed. That's where that comes from. So the whole point is we know who's there because we've controlled it, all right? So I also feel like if you're going to let people vote, think about who's voting, and the decisions that you do will be a function of the intellect of the people making them. So if you have a group of people that you've brought in that you want to make high quality, extremely intellectually data-driven decisions, that is probably not a very good decision to give it to a group vote, right? So you really want to think about, like, that would be a better decision to have the group would elect people they trust, like our politicians do, and have it work from there. In fact, I don't think there's ever been a society in history, the reason why we have the government the way it is the flat structure has failed every time they've tried it. Where everybody gets an equal say. It's always been, you have to elect people, right? Because people are different. You have to elect people in certain cases and let them run things. And then you still have your vote as a person, right? You still have that. I think it's kind of the same thing, if that makes sense. I don't think it'll work any other way. It hasn't. Any other time any country has tried, it fails every time.
We end up facing a concentrated power structure, right?
Yeah.
Yeah. Which what do you think? What structural forces
fix
cause
that?
this outcome repeatedly, and how? Yeah. How do you fix that
Yeah.
in this space?
So, well, quadratic voting is one way that we've tried to solve it, right? So if someone has more tokens than they vote, then it actually has a diminishing return effect that's applied over time, right? So it basically takes, like, the exponent is like a 0.5. So it's like it applies a square root to what you're voting with, right? So if you have 1,000 tokens and I've got 10, you're going to have more voting power by me, but it's going to start to diminish over time, right? So I think, like, as you look at that as an example of something that can work well. However, in a case where I think it cannot work as well is if you have a system where you have the largest liquidity providers, and then I would want to connect, for example, if I have 20% of the money in the pool, I would want to have a lot more control over what happens in that pool because it's my money there, right? Versus having it be all flat, as an example, right? Because I have more control, just like as the stock markets, right? The same way. So when I look at, like, what has actually worked from a human psychology standpoint, that's a great example of one that works in the stock market, as an example, right? Where people can kind of vote, like, yeah, that kind of governance and thing works. So I think you always have to just you have to be reasonable in how you're putting it together. I don't think every project needs governance, but you also need to, again, be mindful of who's making the decisions and setting it up the right way. So, if that makes sense. So, like, as an example, I might not always want to have it where the DAO has, diminishing returns. They have kind of that quadratic voting. I might want to change that, as an example, for what I just said, where it's like the biggest holders should have the biggest say. That's how it should work, right? If you want to have more say, put more money in. You know what I mean? That should maybe be the way to frame it in that system, right? So I think it depends on what you're doing. It always depends on what you're doing, because it always goes back to the psychology of the people.
Based on your experience in the space, right, and your expertise in tokenomics, what do you see? Which segments are the ones people should focus more on, and probably even trust a bit more in the future?
Yeah, I think you're going to see a lot in the real world asset space. So real business coming on chain, like you'll see manufacturing, you'll start seeing a lot of things like that in here. So as I look at it, the real business could not be on chain because of the regulatory issues. And a lot of times these businesses have, a lot of value. So they're worried about being sued, right? So I think we'll see a lot of that coming in, using it more enterprise level. So also payments, of course, it's going to be used there. But I think as things get more tokenized, people will see the power of smart contracts and we'll see a lot more uses. So I'm one where I'm very much into real world assets right now because of all the speculative, that has not proven to be very good. It's like we have to figure out, how do we take this real value that's in the real world now and get it on chain, but not just bring it on chain, and find new ways to use it through distribution, right? That's what we need to do, because it's not enough to say the house is now on chain. Great. What am I doing with it now? What benefit does it have? Again, value, right? So that's what I'm really interested in, is now that we have regulation, how do we tokenize and have legal structures? So, when you own the token, you actually own the real thing. That's really important. But how does that tie in, right? And so when I look at the UAE and what they're doing with the Dubai Land Department, and, for example, they're using, for their deeds, you can have your tokenized properties now. I'm not sure if you know that, but you have that in the DLD. It'll actually give you a certificate showing your tokens of your property, which is pretty unique, right? So that's going to use XRP. Again, I don't like XRP, but it's using XRP for that case, right? And they're all fully integrated. So that's using crypto, which integrates fully into that. So you can rent a property on Pripco and actually have tokens on a real deed, on a certificate from a real government. That's happening right now, right? So when I look at kind of the future, I think we're going to see more touches of that and expansions into that with real value. And then my hope is also people aren't worried, like I said at the beginning, that this is a scam, because it's a real business, right? When I'm using Stripe or buying a product online, I'm like, wow, this might be a scam. I'm going to lose my money, right? I know my money is going to go to the person. I'm going to get the product, right? So when I look at what we're doing, that's an important piece of it too, right? That's what I believe.
As for the closing question, where can listeners connect with you and learn more about what you're doing?
Yeah, they can go to tokenomics.net. Very easy. Or see me, Tony Drummond, on LinkedIn. That's where I produce all my content. So I'd love to have you reach out if you need help in tokenomics.
And I will include all the links in the descriptions. So, Tony, thank you very much for joining me and unpacking tokenomics as economic structure and infrastructure, right, rather than narrative design. And to everyone listening or watching, like, subscribe, or follow both of us, right, and share this episode with someone curious.